Welcome to Market Catalyst. I'm Allie Canal. We're 30 minutes into the U.S. trading day. Let's get to the three market catalysts for watching this hour. First up, a fresh read on the labor market with a July JOLTS report just crossing the wire, what the data means for the Fed's next move. Plus, 30 years since eBay went public. We're talking to the CEO about the e-commerce market as consumers continue to seek value. And Macy's topping second quarter expectations and raising its full year outlook. We have the highlights from our conversation with the CEO. All that and more coming up on Market Catalysts. But let's first get a check on the markets, and you're taking a look at the major average. It's still a mixed picture here. The Dow is off roughly 200 points. The S&P 500 is up around 0.3%. The Nasdaq leading the way higher here among all the major indexes, up roughly 0.8%. And of course, a big reason for that is that court case that we saw with Alphabet. You're seeing Google shares, Alphabet shares are up around 9%. This comes after a federal judge declined to force the company to spin off Chrome or Android. The ruling also allows Google to keep its default search deal with Apple. And that's also why we're seeing Apple shares move a bit higher today, up roughly 3%. But across some of these magnificent seven names, you're seeing Nvidia up around 0.5%. Amazon also up, Meta up marginally. And when we look ahead, analysts have told us that this maybe loosens some of those regulatory hurdles for big tech. Something to continue to keep an eye on. We also have our eye on the bond market. It's particularly the 30-year yields, as we've seen 30-year yields creep up closer to that critical 5% level. We know what that yields, that starts to pressure equities. We do have a little bit of buying in the bond market right now, reversing some of that earlier sell-off. We are down around 3 basis points, trading just below 4.95%. 10-year yield, similar story there, off just a bit, 2 basis points. We are firmly below 4.3%. So we'll continue to monitor the bond market, especially with all these risks with inflation and what the Fed decides to do later this month. And in the meantime, the August job openings and labor turnover survey, or JOLTS, showed 7.18 million job openings in the month. And it is a busy week of economic data, culminating in the August non-farm payrolls report Friday, September 5th. Investors watching closely for any signs that could shift the Fed's rate path. Stephanie Roth, Wolfe Research chief economist, joins me now. So Stephanie, let's get your perspective on what we saw with JOLTS and how that maybe sets us up for Friday's jobs report.
Yeah, I mean, the first thing to remember is that the JOLTS report reflects the month of July. So it is a lagging information. It does paint the picture of a slightly softer labor market. The layoffs rate in particular, that said, the prior month was also revised up. So the layoffs rate ticked up versus consensus, but the prior number was also a bit higher. The picture is a labor market that has softened quite a bit, but it's not necessarily weak outright. So it looks like layoffs are still fairly contained, and it's really just a low hiring, low firing environment, in which case, it's a more challenging environment for the Fed later this year. So it certainly looks like the Fed's likely to cut by 25 basis points in September. Beyond that, it becomes a little bit more challenging as the labor market, rebounds a bit from what we're seeing in the summer. Our expectation is it looks better later in the year. And then you start to see inflation pick up a bit. So the narrative could get a lot more challenging than it is today, which is sort of dovish price action.
Mm-hmm. Now, looking ahead to Friday, payrolls are expected to once again slow, and you're calling for 70,000 jobs added. This is slightly below consensus. How significant is it if we continue to see payroll numbers below 100,000? Is that just the new normal, especially considering the immigration crackdown and this low hire, low fire environment that you were just mentioning?
Yeah, it kind of has to slow down. If we were running above 100,000 jobs, that would be an issue because there's just not the labor supply to support that. So it should slow down below that 100,000. Somewhere in the 70, 80,000 range is kind of the steady state payrolls environment. It seems like the earlier months were a reflection of extreme economic uncertainty, particularly tied to tariffs. On top of that, there were major changes that happened from an immigration perspective. So that led to some significant weakness over the summer. We do expect later in the year, you're going to get a bit of a cyclical rebound, and you'll start running closer to that 70,000 trend, which is really something that's quite solid and a signal that the labor market is in a decent balance. So our expectation is, while we might get some softness in the most recent report, 70,000, but also some potential downward revisions to the month of July, You also get the preliminary annual revisions on September 9th. Then beyond that, the narrative might shift. So this dovish narrative may remain in markets for the next couple of weeks, but beyond that, we actually think that you'll see kind of similar to what you saw last year, where the dovish narrative gets priced out a little bit and it becomes a little bit more, not necessarily hawkish, but certainly less dovish than what's in the price.
How closely do you think the Fed pays attention to all of these revisions, especially as you just laid out? We might see more revisions to July. We have the September 9th annual revisions. How much could that change the calculus when they're thinking about rate cuts?
Yeah, so the revisions to July could surprise folks just because they're going to be looking at the most recent 3-month run rate, and to the extent that July ends up being softer than the 73,000, that will be certainly important for the Fed. In terms of the annual benchmark revisions, we largely know that because we get the QCEW data that is linked to the unemployment insurance records. That's what they use to do these revisions. So we already know that data. We know it's going to be revised down somewhere in the 400 to 600,000 range. So that shouldn't have a big impact in terms of the Fed's thinking. That's also backward looking. That's for the period from April of 2024 to March of 2025. So I would say the annual benchmark revisions aren't important for the Fed, although it might catch the market's attention. The revisions to the most recent 2 months in terms of payrolls, that will be quite important.
Mm-hmm. And what other metrics should investors have their eye on? Is it wages? Is it the unemployment rate? What are you focusing in on Friday?
Yeah, the unemployment rate is going to be important, largely because that helps to offset in terms of the numerator and the denominator calculating that. Mm-hmm. It helps to offset what we're seeing in terms of immigration. So that is, certainly what the Fed is targeting and focused on most closely. So something like a 4.2 would make the Fed feel a little bit more comfortable about the backdrop. If it happened to rise to 4.4, which is not our view, we're looking for a 4.3. That would get the Fed a little bit more concerned about the labor market. So unemployment rate is most important. And then secondly, they're going to be looking at the trend in payrolls growth, even though we know that there is an impact of immigration and it's a little bit hard to measure how much. If we get a number that's around 50,000 or below, they would start getting a little bit more concerned because that would just validate the slowing trend. It wouldn't concern us so much because we do expect that immigration has had a big impact on the labor market, but it certainly would get the attention from the Fed because they're risk managers and they have to ensure that the labor market isn't getting weaker than that, even if it's not their modal or base case.
And you were just saying the call for September, how we will likely see that rate cut later this month. But beyond that, there's a big question mark. How worried are you about stagflation risks, especially if we're in a market where the labor market is slowing considerably and we do have persistent high inflation? When you look at stagflation and the Fed potentially cutting, how do you square the two?
So when we talk about the tariffs being stagflationary, I would say it in a very mild sense because we're talking about inflation running above 3%. We're not talking about inflation 6, 7, 8, 9%. So it's an elevated, sticky inflation, but it's not something that's overly concerning. It's just a problem for the Fed. And then from a growth perspective, similar thing. Growth is running around 1.5% this year. It's a lot slower than where it's been, but it's not zero and it's not negative. So while it has sort of stagflationary dynamics, it's not sort of stagflation in the true sense. So we are worried about that. So to some extent in directionality, we do think inflation will be a little bit more elevated. Where we are a bit different from consensus is our expectation is that growth will start to pick up again. And that a lot of the reason why we've seen such sluggish growth most recently in the past couple of months has been more a function of tariff uncertainty. As that uncertainty starts to fade, just because we have a little bit more clarity on kind of where tariff rates are going to settle out roughly, looking ahead, economic activity could resume, and we'll see a better environment from both consumers and businesses.
Mm-hmm. And AI, too. That's a story that we've been consistently hearing when it comes to productivity. Stephanie, thank you so much. Appreciate your insights. All your market action ahead. Stay tuned. You're watching Market Catalysts. Macy's jumping after reporting better than expected second quarter results and raising its full year guidance. Yahoo Finance's Brooke DePalma joins me now. And Brooke, you just spoke to the CEO. What did he tell you about the quarter and what's to come?
Yeah, Tony Spring is very bullish going into the holiday season when it comes to Macy's. He said, he's kicked off the call saying it was a beat on both the top and bottom line. They saw strength across all three nameplates. That includes luxury retailer Bloomingdale's, as well as their Macy's key brand, and also the cosmetics retailer Bluemercury. But he said that this is the beginning of momentum. We know that Macy's has been on this turnaround strategy dubbed Bold New Chapter for quite some time since CEO Tony Spring took the helm. And now what they've seen is that they continue to put in more merchandise as well as staffing in what they call a reimagined 125, and they plan to expand that into more stores. That will be announced in the Q4 earnings call. He also said, when I asked about if the right size or the portfolio was the right size right now, he said they do have plans to close further stores after they announced that earlier this year. But he went on to say, when I asked about the impact that tariffs has had on the company, he said that uncertainty really lingers. He said no one really could have predicted that there would be a 50% tariff on India or Brazil, and they're navigating that level of uncertainty with agility as well. But lastly, the key point here is Macy's is really catering to the consumer, finding the right price and the right category and the right offering. He said the consumer is resilient, but they do remain choiceful. And on the call, he said, quote, "There's resiliency in the consumer right now. We don't control whether or not the consumer is feeling like buying or is watching good news or bad news." He went on to say, "I continue to believe we are a form of retail therapy. We are an opportunity of escapism from all the noise and all the chatter that's out there." And of course, Tony Spring is a tenured executive at Macy's, formerly of Bloomingdale's. And he said that this is really the best position that they've been in heading into the fall under his tenure as CEO.
A lot of optimism there, Brooke. Thanks so much. Well, Dollar Tree sinking after warning its current quarter would be flat due to tariffs. Still, the discount retailer topped second quarter expectations and raised its annual forecast. Yahoo Finance's Brooke DePalma is back with me, along with Arun Sundaram, Senior Equity Research Analyst at CFRA. So, Brooke, let's start with you here on Dollar Tree. How significant is this tariff impact?
Yeah, well, what we heard on the call was this Q3 outlook is going to be the same for adjusted earnings per share than what it was last year. That's not really what Wall Street was looking for here. So it seems they really wanted it to come in at $1.32 for Q3, but it's expected to be the same as last year for $1.12. But what we did hear on the call, a few key takeaways, was the full impact of tariffs remained to be seen. They said that they still don't know the full impact. We still don't know exactly what happens when it says, come like things like China, how exactly the rate will be there. They called it a very volatile time. But on the flip side, they did see a strong ticket, a nice balance between traffic and ticket. They also said consumables and discretionary both did well for them. They said it's been the strongest discretionary same-store sales growth in nearly 2 years. And also that high-income shopper, well, they're going to Dollar Tree too. That's a consumer that makes over $100,000 per year. They said that contributed meaningfully to the Q2 sales growth as well.
So Arun, do you think investors are being a little too short-sighted considering the positive outlook that they gave for the full year?
Hey, yeah, thanks for having me. Yeah, so I think the stock is down, I think, because of the outlook. Yeah, the company did raise their guidance, but if you look at their EPS guide, their raised EPS guide, they only raised it by about 2% at the midpoint. Yet this quarter, Q2, they saw an 88% EPS beat. So they are implying, some deceleration in the back half of the year. So I think a lot of the weakness today in the stock is due to investors questioning the sustainability of these results, especially as the impact of tariffs come through in the second half of the year. The company right now is in the process of raising prices. They started that late in Q2, and that's going to continue probably in Q3 and Q4. And so as they raise prices, what's going to be the impact to traffic? Because Dollar Tree is not a dollar store anymore. They're selling things at $3 price points, $5 price points, and they're introducing that multi-price format to more and more of their stores. And that's attracting higher income shoppers at Dollar Tree, but it's also, I think, introducing more competition to companies like Walmart, Amazon, who also sell things at higher price points.
Well, to follow up on that, Arun, 40% of Dollar Tree's goods come from China. So given the fact that you said tariffs are a headwind, they're raising prices, what other ways or what other levers could they pull to offset some of that tariff impact? And are they doing that at the same rate of competitors?
Yeah, great question. So I think, really all retailers right now are currently trying to mitigate the tariff impact. Their first line of defense is really trying to negotiate with their suppliers and lower the prices with their suppliers. If they can't do that, they're shifting sourcing to alternate countries, moving away from China and going to other countries, mainly in Asia. But even right now, we have pretty steep tariffs with countries like India, Bangladesh, Vietnam. So that's still a headwind there. And then for companies like Dollar Tree that sell a lot of discretionary goods, if certain things are tariffed at a high rate, you can just stop selling them at your store because you don't really need to. And then last but not least is raising prices. And like I said, Dollar Tree is in the process of raising prices right now and a lot of their merchandise.
And Brooke, you've been covering this space very closely. What are the takeaways when it comes to that lower income consumer and really the bifurcation that we've seen play out this earnings season?
Yeah, well, what we've seen is the low-income consumer remain under pressure. And even yesterday with what we heard from McDonald's is they're introducing those extra value meals in order to cater to that core consumer of that low-income shopper consumer has really pulled back over the past year. And we heard from Dollar Tree as well as Dollar General that this low-income consumer is really being mindful about where exactly they're looking, where exactly they're going for the price point. And just in the earnings call from Dollar Tree's CEO, they said that they're still seeing very strong performance from their low-income customer. They said that the pack sizes that they have and the ability for these low-income shoppers to stretch their budgets has certainly done well for them. And that's really what we heard across the board is this consumer that's waiting for the right price to jump into this market and ultimately get that good. And it's interesting to watch now Dollar Tree play into those multi-price points and also bring in those middle and high-income shoppers as well.
And Arun, I want to get your take on the bifurcation picture as well. What have you gleaned about the state of the U.S. consumer? Are we as resilient as we keep talking about?
Yeah, I think the resiliency has continued. We are still seeing that bifurcation between the lower income consumer and the middle to higher income consumer. Right now, Dollar Tree is experiencing trade down benefits from that middle and higher income consumer. But I think they're still feeling some pressure with that lower income consumer. Right now the company, like I said, is implementing these multi-price point strategy across more of their stores. My big concern here is that the value perception of Dollar Tree, could that be eroding over the longer term as they introduce more of these $3 price points and $5 price points? More and more of these the dollar store format has essentially gone away, and that I think introduces more competition to companies like Dollar Tree, Dollar General, with behemoths like Walmart, Amazon, Costco, Target, those kind of large retailers.
And I believe you have a hold rating on the stock, but even with the 9% decline that we're seeing right now, shares are still up 35%. What level do you think is a good, attractive valuation?
Yeah, so before today's price movement, the stock was trading at around like a 19-20 times forward PE ratio. That's above its historical average of around 18 times. That's one of the reasons why we had a hold rating on the stock, given that that we did see some downside risk to the outlook, given that the company has significant exposure to tariffs and that lower income consumer. But we're still reevaluating after today's earnings call. We'll issue another note later today with an updated target price.
All right, we'll be looking out for that. Arun, Brooke, thank you so much. Appreciate it.
Thank you.
Coming up, we take a look at some of the top trending tickers on Wall Street. Plus, I speak to the eBay CEO about the end of the de minimis exemption, along with the health of the consumer and more. That's on the other side of the break. Now time for some of today's trending tickers. We're watching oil, Zscaler, and SoFi Technologies. First up, looking at oil. Crude oil prices sliding following a Reuters report that OPEC Plus will consider another increase in supply. The group has already raised quotas by 2.5 million barrels per day this year. That's in order to grab market share. This being a reversal of its strategy in April. We are seeing oil-related stocks under pressure on the potential boost to oil production from OPEC Plus. ExxonMobil, Chevron, and ConocoPhillips all lower in today's trade. Next up, Zscaler, the software company reporting better than expected fourth quarter earnings and revenue. Zscaler noting a new milestone of more than $3 billion of annual recurring revenue. Calculated billings for the quarter also coming in above analyst estimates. While looking at the company's outlook, JP Morgan highlighting Zscaler's conservative guidance as its zero trust platform takes shape. Finally, SoFi Technologies, the company announcing the availability of a new exchange-traded fund, the SoFi Agentic AI ETF, to provide access to the next wave of artificial intelligence. The index currently includes 30 holdings with the inclusion of companies such as Salesforce, Tesla, and NVIDIA. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, the end of the de minimis exemption is expected to add hefty charges of up to 50% on small packages entering the United States. So what does this mean for the e-commerce landscape? Joining me now with more is Jamie Iannone, eBay CEO. And Jamie, I know you're down at the NASDAQ celebrating 30 years. You rang the bell this morning. We're going to get to all that, but I wanted to start on the de minimis exemption because on the call, you did say that that caused some disruption when it comes to China. That exemption in Beijing was in May. Now that we've seen that expand, how are you handling the changes to your business?
Yeah, I like to say at eBay, we're not immune to it, but we're more resilient. And that's because of the breadth of sellers and buyers that we have on the platform. We've been dealing with cross-border trade and helping them for 30 years now on eBay. So when you look at China, our sellers were actually very nimble. And as de minimis was introduced a couple of months ago, they actually started to open up new corridors, like shipping into UK and Germany overall. And buyers have a lot of choice on eBay. So if they want to buy from other countries, they want to buy domestic products, it's one of the great things. We have 2.4 billion listings on the platform. Even the most recent news was contemplated in the guidance that we put forward.
And do you think the de minimis ending that exemption, does that make U.S. sellers more competitive, or is the added cost not at a level yet where consumers are choosing those U.S.-based products versus maybe some of those cheaper alternatives overseas?
Yeah, what's great is consumers can choose from 190 different markets from around the world. And when consumer dollars are stretched, they actually turn to eBay because of value. 40% of what we sell on the platform is used or refurbished. And so that's a real advantage for us to have. Small businesses on eBay, they sell throughout the world, and we make that really easy with different shipping solutions that we provide. We provide SpeedPack. We have a program called eBay International Shipping. So as a platform, it's really about how do we make it as easy as possible for sellers to deal with cross-border trade.
And outside of de minimis, there's also the tariff landscape, which continuously keeps changing, a lot of confusion for both businesses and consumers. How have you been leading the company through this uncertain time?
Yeah, the biggest thing we've been doing is making sure that we've enabled the platform to be seamless. So, for example, for our business out of China, 3/4 of that is forward deployed to the US. Our sellers are already putting it close. And for the other half of direct ship business, we build solutions like SpeedPack. So for buyers, there's complete transparency. It's very clear what to see. We've also been building solutions so that consumers here in the States can ship to 190 different countries with ease. So essentially, if we were here in New York City and we wanted to ship to Poland, all the seller has to do is ship it to Chicago, and eBay takes care of the rest, the duties, the taxes, the returns, really simplifying life for our sellers.
And what's your read on the U.S. consumer right now, how they're interacting with your platform? We've been talking a lot about the higher income versus lower income consumer and this bifurcation. What have you gleaned from some of the behaviors and spending habits from your customers?
Yeah, in the U.S., our consumers are actually hanging in there. We talked about in Q2 that our U.S. business grew 7%. In our focus categories, the ones where we're really leaning in, we grew 10% in the quarter. And so we're really seeing strength in the business. And that's across motors, parts, and accessories, luxury items like handbags and jewelry, to sporting equipment, to back-to-school uniforms. I would say there's been a bifurcation between the U.S. and international, much more challenging environment in UK and Germany right now than what we're seeing in the U.S.
And why is that, Jamie?
I think what we originally thought at the beginning of the quarter was maybe this was pull forward demand from consumers. But what we talked about is that lasted all throughout Q2 and into the start of Q3. I think the other thing that's unique to eBay that we see is that consumers often do trade down to a used, to a refurbished item on the marketplace. Or when their dollars are stretched, they start to sell things. And that actually helps grow the overall flywheel of the business that we see on eBay. And so it's been encouraging to kind of see those results.
Yeah, that flywheel equation is interesting for your business in particular. And in terms of the categories, it sounds like you're seeing still resilience among a variety of different products. Are there any categories that maybe are a bit more sensitive in this time where, consumers are a bit more stretched?
Yeah, we're really seeing strength across the board, across the business. Our motors, parts, and accessories business is doing well. We have 5 categories that are over $10 billion. And part of it is we're actually taking share at eBay. So when you look at our focus categories over the past few years, we've taken market share. And that's really because we're doing new things like, we're authenticating products now. We authenticate watches and handbags and jewelry and trading cards. In fact, we've now authenticated our 15 millionth item on the platform. So that trust is giving people comfort in buying on the platform. eBay is also a reflection of what's happening in pop culture. People are shopping for K-pop Demon Hunter things. They're shopping for Taylor Swift's engagement dress. Pokemon is really exciting right now. So we're seeing enthusiasts really lean in because eBay is a destination for enthusiasts.
And Labubus, right, Jamie? I think there was the most expensive Labubu in the world just sold on eBay. What have you seen there in that market?
Yeah, it's exciting to watch. We introduced this new thing called eBay Live, where sellers are doing these live sales of selling their items. And so, Labubus are going for a lot. We just sold a Patek Philippe watch for $75,000. The Backstreet Boys were on last week kind of doing an eBay Live. So it's bringing this whole new community to life. And what's fun to see is the intersection. You really see pop culture come to life on eBay.
And earlier in the segment, we talked about 30 years on the NASDAQ. As you look ahead to the next 30, what's going to be the growth engine for eBay? I know you guys are doing a lot with AI.
Yeah, I'm so excited to be CEO of this company right now with the new Gen AI capabilities because it's really changing the experience on eBay to be more magical. Think about if you got those trading cards sitting in a closet at home. Now you can just hold up your phone to an item and we figure out exactly what that item is. We write the description for you. We put it on a beautiful background for you and fill in all the data fields. And the average household has $3,000 to $4,000 of stuff that could be sold on eBay, and less than 20% of that is online. So it's exciting to see how we're using AI to really innovate on behalf of sellers and buyers on the platform, and we're just getting started.
And talk to me a bit more about how you can really become a more personalized seller on eBay through the utilization of some of these AI tools.
Yeah, it's really about making your life simpler, right? So now, if you're using these AI tools to list, you can get twice as many items up on the platform and really grow your business. Just a few weeks ago, we announced that we're bringing AI to member-to-member messaging. So when a buyer asks a seller a question, they can actually use our AI tools to answer those questions if the answer is sitting right there in the description of the item or it's a common question. We can do translations. So you can have a buyer in France who only speaks French buy an item from a US seller, and they can actually communicate really easily via our member-to-member platform. We're using recommendations in a completely different way. Take fashion and apparel. You can now shop the look you want to have on the platform, to see the products just in your size. And so for both buyers and sellers, it's a real game changer for the magicalness of shopping on eBay.
And finally, Jamie, before you returned to eBay, you were at Walmart, you were at Sam's Club. These are companies that are really looked at as consumer bellwethers. So what did you learn through your experience there that helps you lead today, again, when the consumer is just so top of mind for the economy?
Yeah, when I came back to eBay 5 years ago, I really refocused the company back on re-commerce because I think it's an amazing space for eBay to own. Consumers need used and refurbished items. There's so much to unlock. And when you look at it, the younger generation especially is really leaning into sustainability and the planet. They're willing to buy pre-loved clothing. It's more chic to buy a pre-loved handbag than a new handbag. And so our strategy at eBay has really been designed around category by category, building the best experience for re-commerce and non-new and season items. What we see, it's growing faster than new items on the platform. And it means that the majority of traffic that we get comes to us directly at eBay or on the eBay app because they love the inventory that we have on the platform.
Jamie Iannone, eBay CEO, thank you so much for your time. And again, congrats on 30 years. All
Thanks,
your market
Allie.
action ahead. Stay tuned. You're watching Market Catalysts.
Well, nearly half of full-time workers, or those looking for full-time employment, say they are likely to search for a new job in the next 12 months. That's according to a new bank rate survey. But for workers going from job to job, Bank of America highlights what job changers may expect to face in the current labor market. For more, we have Bank of America Institute economist Taylor Boley. Taylor, it is great to see you. So you did some research on job hoppers. First, explain to us, kind of big picture. As an economist, Taylor, why do you study job hoppers? Why that metric? What are you looking for there? What does it suggest about the labor market more broadly?
Yeah, of course. So I think right now, especially what we heard from Powell at Jackson Hole, he cited some downside risks to the labor market. And it's easy to look at an unemployment rate, look at payrolls, what we're seeing there. But some of these more under the surface questions around what are people doing in terms of looking for a new job, or people changing jobs as frequently, as well as the pay raises they get from them, is kind of telling to see to what extent we might be seeing a slowdown in the labor market.
And so what are you seeing with job hoppers? What does the data suggest?
So our data, which we look across over 69 million consumer and small business accounts, so it's a pretty powerful data set. And what we found is that there's been a moderation in the number of people that are changing jobs, the job change rate, and it's only up 2% from 2019.
So they're hitting pause.
Yeah, exactly. And on top of that, let's say, hypothetically, you're looking for a new job. Most people, when looking for a job, think, okay, what pay raise am I getting with this job change? And so you might say, that'd be great if I could get 10%, which is what we saw in our data back in 2019. Now we're seeing that around 7%. And compare this to the Great Resignation period, where it was up more than 20%.
Is there, when you try to look under the hood there, Taylor, and explain that trend, what would be some of the reasons?
Right. So we're seeing generally an uncertain economic environment. That's weighing on people looking for a job. It's weighing on those that are making the hiring decisions.
This is sort of tariff-induced uncertainty.
Yeah, that's definitely part of the equation.
Yep.
And on top of this, we're just kind of seeing the power dynamic shift back to those employers, as opposed to what we saw in 2022, when there was a lot more power in the hands of the employees, those looking for job changes. So really what we're seeing now in our data is that changing jobs has just become less lucrative.
It's become less lucrative. Are there sort of demographic differences to call out when it comes to the job hopping theme?
Yeah, so we're able to look at pay frequency when looking at job change rates. And what we're seeing is for those that are in professional services, so think finance, think information, it's more difficult for those white collar workers to change jobs. And then on top of that, in official data, we're also seeing younger generations experiencing a higher unemployment rate than they did pre-pandemic.
Why is that?
Yeah, it's an interesting question. So part of the reason that we think that is there again is this question of, okay, uncertainty. There's also our B of A global research teams are citing there could be an AI impact here, especially in those professional services area, potentially crowding out some of those entry-level positions.
I see. So one theory might be that AI is already impacting certain sectors, or at least entry-level positions that would be hitting younger folks.
Right, and so on top of that, we're also seeing within our spending growth data, within our wage growth data, some divergence between also lower and higher income households. And at the end of the day, the labor market is so key to understanding how overall consumer health is doing, because at the end of the day, the money that you're bringing home is going to determine what your budget is, how much you're spending, what you're spending on, and the overall impact to the economy.
What about the big jobs report this week? I'm curious, what do you all think is coming? What do you expect to see and hear?
Yeah, I think all eyes are on the job report this Friday. And what I would say is what we're seeing within our data is really confirming that we're seeing some of that slowdown, some of that moderation, the cracks beneath the surface in the labor market. But I would point out that we're still seeing, again, it's come down, but 7% is still a positive number. We're still seeing an increase from what we saw in 2019 when it comes to job change rates. So there are still some positive indicators out there.
As economists, do you think you all have is it possible to get a good firm read on the health and resilience of the labor market, Taylor, when you have some of these big policy shifts that are occurring, like Trump's immigration policies and the reversal there?
Yeah, I mean, it definitely makes our job, we got to stay on top of it. But again, because we have over 69 million consumer and small business accounts, that's a whole treasure trove of data. And what we're seeing is pretty real time. So that allows us to better understand and gauge how consumers are doing, how small businesses are reacting to things such as tariffs. And what we're seeing is, again, slow down, but there's still positive growth.
All right, Taylor, thanks you so much for your time today.
Yeah,
Appreciate
of course.
it.
Thanks, Josh.
The combination of an uneven labor market, declining consumer consumption, and a potential September rate cut give investors a tricky roadmap for the fall season. BlackRock's outlook for Q4 aims to provide some insight. Let's bring in Christy Akulian, BlackRock's head of iShares investment strategy for the Americas, for this week's ETF report brought to you by Invesco QQQ. Christy, thanks for being here. Now, in the outlook, it does say that the classic stock bond diversification model is breaking down. So what exactly does that mean?
Yeah, absolutely. And thanks for having me. It's great to be here today. When we look at the typical portfolio allocations and thinking about sort of that traditional 60-40 portfolio, if you're a US-based investor thinking about kind of a 60% mix of stocks and 40% of US bonds, really what you've experienced over the last 5 years is really significantly different from what you experienced in the 5 years before that. Two things have happened. One is that bonds have gotten riskier overall. We've seen the volatility in things like the ag really move higher. At the same time, returns have moved lower. And the second really important thing is that we've seen a much more positive correlation between stocks and bonds. So those are moving together rather than providing some ballast or defense in a portfolio. So there's a variety of ways that we see investors responding to this. I think one of the more interesting and the more important ones is just looking to maybe alternative investment strategies, alternative asset classes as ways to build in some of that deliberate diversification that you might not be getting from bonds anymore. So we've seen this reflected in ETF flows, certainly, and in the way investors are putting together and building portfolios. If you look at kind of the pre-pandemic average, we saw about 0 to 1% of allocations into alternatives, whether that's commodities or digital currencies. In 2025, that's as much as 8%. So investors are really seeking differentiated sources of returns and differentiated sources of diversification as well.
And to your point of bond market volatility, what do you make of the recent sell-off that we've been seeing in the bond market? And if you are an investor who wants some exposure to fixed income, are yields at an attractive point right now with the 30-year approaching 5%?
Yeah, absolutely. And we certainly are not suggesting that anybody should abandon the asset class. We still think that there's tremendous opportunities within fixed income. Timely, we just published our fall investment directions paper yesterday, and we're obviously seeing a bit of a backup in rates globally today. This is exactly in line with what we expected, and that even though we do think the Federal Reserve is prepared to cut rates in September, we're still cautious on the long end of the yield curve, both in the US and globally. We expect that there's going to be a higher amount of term premium priced into the long end of the yield curve. Those concerns around debt and deficits, those are really being manifested there, as well as being adjusting to potentially a higher inflation regime. So we see the best opportunity within fixed income and really focusing on the income portion of fixed income. Something like BINC, which is the BlackRock Income Active ETF that's managed by Rick Reeder and team, it really can focus on not just the ag. I talked about the rise of volatility and risk in the ag, but looking at some of the plus sectors. So expanding the opportunity set, focusing on income, and then limiting exposure to the long end of the curve. We really have a preference for sort of the 3 to 7 year point, which we would call kind of the belly of the curve, as the place to take risk in fixed income and the place to source your duration from right now.
Yes, we've been hearing a lot about the benefits of really targeting the belly of the curve. But what about some other non-traditional assets that you could or should have in your portfolio? How are you viewing things like crypto, for example, and the risk tolerance there as well?
Yeah, absolutely. So, I think that both gold and digital currencies, so something like IAU, certainly something like IBIT, is where investors are turning to, again, for those differentiated sources of risk and return. that is not necessarily to say that cryptocurrencies are for everybody. Certainly, that they should be thought of, certainly as a more volatile. We would think of it as a risky asset, but they can provide an additional source of diversification in a portfolio. And in a world where diversification is so much harder to get from your traditional asset classes, I think it can make a lot of sense for investors who are able to take on that additional risk.
Mm-hmm. And speaking of a lack of diversification, we have seen big tech lead markets higher. The NASDAQ continuously has been an outperformer even today. And a big part of that story is AI. If you are an investor trying to play the AI game right now, but you're maybe a little nervous on the valuation levels, how can you get some of that exposure?
Yeah, absolutely. We think that AI is still a place where it makes sense to be active. That world is changing so quickly. And obviously, there's a lot of fundamental analysis going into just how much CapEx spending there is, what sorts of returns companies are being able to get from all of that spending. BAI is our flagship BlackRock AI ETF that targets exactly that. So it looks for opportunities, both from sort of the hyperscalers, but also from the companies that are able to benefit from AI. You mentioned valuations, and I would say it is the most frequent, question and concern I think we get from the investors that we speak to. Just to give you a little bit of sense of where returns have come from this year, though, if you look at that breakdown, the companies that are returning the most, the parts of the equity market, specifically tech and communication services, where we've seen prices rise the most, are also the places where we've seen earnings the most. So it should give us some amount of comfort that those returns are fundamentally driven as opposed to speculative and really just a reflection of valuations getting more expensive.
Christy, really timely report here. Thanks so much. Appreciate it.
Thanks for having me.
Coming up, a full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst, first up, regional banks could benefit from a potential Fed rate cut. We're looking at ways to play the sector. Plus, how Fed Governor Lisa Cook's potential departure could impact the FOMC, and how major food companies are navigating economic pressures from potential breakups to activist investors. We're tracking the latest moves across the consumer sector. 90 minutes into the start of U.S. trading, I'm Allie Canal. Let's get a quick check of the markets. You're still seeing that mixed picture there, although the Dow is well off of its session lows, just down around 70 points. The S&P 500 is up around 0.6%, and you're seeing the NASDAQ soar up 1.2%. Of course, this follows shares of Alphabet, which are surging today after a judge ruled that the company would not be forced to sell its Chrome browser. That's helping lift the broader tech index. Well, the July job openings and labor turnover survey, or JOLTS, showed 7.18 million job openings in July. That's below expectations for 7.38 million, and also down from June's headline number. And according to a new Glassdoor report, many workers are feeling uneasy about the current state of the labor market. Joining me now is Daniel Zhao, Glassdoor's senior economist. So Daniel, let's start with the latest economic data that we saw, JOLTS, pointing once again to that softer labor market. How does that coincide with the work that you guys are finding at Glassdoor?
The JOLTS report really shows that the job market right now is in a bit of a holding pattern. And in particular, we are seeing low turnover. So sluggish hiring, sluggish quits. That really points to a labor market where workers don't feel like they can climb the career ladder. And that's why we're seeing on Glassdoor so many workers feel uneasy and anxious about the state of the job market. We see that employee confidence is actually pretty close to a record low in our data, stretching back to 2016. So overall, as people feel like they aren't making progress in their careers, that's really impacting how they feel about their employers and their jobs.
That's the worst feeling, when you feel stuck. But it's also interesting because senior level employees saw the sharpest decline in confidence. So even those that are maybe higher in the food chain, if you will, of these companies are also struggling.
We have seen that senior level employee confidence has dropped more dramatically in recent months, and I think that's particularly important because those are the employees who are making decisions around how much to hire, how much to invest, what the budgets are, and so really tracking that cohort of employees is important as we look forward to seeing where hiring might net out for the rest of the year.
And how does the expectations and confidence change depending on the sectors, what jobs these are focused on?
Well, perhaps no surprise, we've seen that white-collar industries have seen more of a decline in employee confidence in recent months, and that's really, again, not a surprise given all of the headlines about layoffs in these industries and, again, the sluggish hiring that's going on. I think sluggish hiring is something that maybe doesn't get quite as much attention as a layoff might in the news, but that really has a very broad-based impact. It means that folks can't get onto the career ladder in the first place, and it also means that workers who are employed can't make progress up the career ladder.
How much does that have to do with artificial intelligence, especially within those white-collar jobs?
Well, it's interesting because when you look at the tech sector, you don't really see the benefits of AI and data center investment showing up in how tech workers feel. Tech employment is still pretty flat over the last few years. And I don't know if we have a lot of evidence that artificial intelligence is specifically reducing the amount of hiring that companies are doing, but we do know that workers are very anxious about this. So we actually just put out some data that shows that Gen Z is quite anxious. About 7 in 10 workers report being anxious about their long-term career prospects because of AI, and that's no different for some of their older peers as well.
Do you think AI is making that entry-level job obsolete at this point? You were just talking about Gen Z workers. Is the entry-level job most at risk here?
I wouldn't say that entry-level jobs are obsolete. There's always going to be work that needs to be done by entry-level workers, but entry-level workers have less to fall back on, right? They don't have a resume or a network built up that they can rely on if there is disruption to the industry that they're looking to get into. So it's not a surprise that entry-level workers feel like their jobs are most at risk from AI.
And we've also seen industries like construction, real estate, they've seen some of the steepest year-over-year drops, and we have an environment where high interest rates are dampening a lot of that demand. How is that comboed with the immigration crackdown? What does that tell us about these industries that are closely tied to the performance of the economy?
Well, we are in a state right now where the job market is really relying on basically just healthcare to drive jobs growth. And we are seeing these other industries that are more pro-cyclical industries like construction and real estate not only see a slowdown in jobs growth, but also in Glassdoor data that decline in employee confidence as workers on the front lines, on the ground, they're seeing the impacts of the slowing economy.
Right, and healthcare dropped below 50% confidence, and it has been one of the main drivers, if not the biggest driver, consistently in jobs reports. So if we start to see less workers there in healthcare, what does that mean overall for the jobs picture?
Well, healthcare is definitely an important industry to watch because if we didn't have job gains from healthcare in the last 3 months, we actually would have had net job losses in each of the last 3 months. So definitely an important industry to watch, and especially important given the JOLTS report this morning. We actually saw job openings for healthcare and social assistance drop below their pre-pandemic highs. And so as we track which industries are really going to be the ones powering the job market moving forward, healthcare is an important one as the population gets older, and because of how narrow jobs growth is right now, we really need to see the healthcare industry remain strong in order to keep the job market growing.
So you talked about a lot of risks facing these employees. In your survey work, what is the number one concern that you tend to hear?
Right now, it's really about that lack of career progress. You said earlier, people hate feeling stuck, and that's what people are feeling right now in their careers. It's not even that there is some concern about job security, obviously, with the layoffs that are in the headlines. But even for people who are still employed, who haven't lost their jobs, they don't feel like they're getting rewarded for the amount of work that they're putting in, and that's creating disengagement, discontent, and as workers find it difficult to hop to a better job, a lot of workers feel stuck, they feel resentful of their employers, and they don't feel like they are truly engaged at work.
So what can employers do in order to alleviate some of these concerns? Is that even a possibility at this point?
Maybe the quote-unquote easy answer is to maybe reward your employees with a raise or promotion where it's appropriate, but obviously employers are facing constrained budgets right now, so it is really important to think about how you can set up your workers for career growth even in an environment where you might not have the budget for that raise or for that promotion. So whether that's helping people reskill or upskill along a different career path, or offering different opportunities for people to try different projects, different teams internally, that internal mobility gives people the opportunity to learn new skills, experience new parts of the business in a way that doesn't necessarily require spending additional money from the company's perspective.
And is that something that employees should be doing in order to future-proof their career if they are feeling stuck? How can you take advantage of the current moment and really make sure you're continuing to build on your skills?
I think that's a great point, because with AI, with how fast things are changing nowadays, it really pays to be flexible, to have a very diversified portfolio of skills and experiences. And so keeping an eye out for that is a great way for employees to beef up their resume and to think about how they can build a career portfolio that's resistant to AI.
All right, well, a lot of things to keep track of on the labor force. Thank you so much, Daniel. Appreciate your time. Well, all of your market action ahead. Stay tuned. You're watching Market Catalysts. Regional banks are catching investors' attention amid the shift in interest rate expectations. With financial markets pricing in rate cuts in the back end of 2025, traditional banks are being seen as net beneficiaries to those expected lower rates. We're taking a look at how to play the sector with the Yahoo Finance playbook. Joining me now is KBW Managing Director and Head of U.S. Bank Research, Christopher McGrady. And Christopher, we've seen the XLF soar this year. Regionals finally catching a bid after lagging behind. What's driving the bulk of this rotation? Is it all based on those expected Fed cuts?
Well, first off, thanks for having me back. A lot of it is. Banks are cyclical. Banks are tied to interest rates. And what you've seen for the majority of the year is the largest banks have significantly outperformed the traditional banks. Really, that difference is 1,500 basis points year to date. That's because of capital markets. The largest banks are more geared to capital markets, and they're more geared to deregulation. What's shifted over the past month has been expectations for interest rates to move down, right? The market is now pricing in 2 cuts this year and 2 more next year. And so if that happens, the view is that it could steepen the yield curve and it could spur loan growth, and your traditional banks are more beneficiaries there.
And you were just talking about the outperformance of the big banks relative to some of those smaller players. Do you think those premium valuations are justified for some of those bigger names?
We do. Our call at KBW is the universal banks are the place to be. And really, it's the 3 triple crown characteristics that we've talked about: the scale, the benefits of deregulation, and really just momentum across the businesses and diversification, the stability of returns. That isn't to say there could be some rotation out of the universal banks to JP Morgans and Morgan Stanleys. These banks are up 20% year to date. Traditional banks are up 5%. Right, so we can see that rotation within the banks. That's happening. That could continue. If that happens, we've got several plays and ideas to recommend. But overall, we still think that the scale is winning, and the largest banks will continue to distance themselves.
So in terms of positioning, then, which of the big banks are you more bullish on, and how should investors think about some of these smaller players too?
Right, at the top of the house, we think you have to own JP Morgan. It's the best bank in the world. It's got the most significant excess capital position, and they're returning, they're producing, call it a 20% return on equity. You go down in terms of value, Bank of America is one of our top picks. The stock trades a couple turns cheaper on an earnings basis. We think the upcoming investor day is a catalyst for the stock. We think they're going to tell the story of improving returns and improving capital deployment. But if you go down to traditional banks, 2 banks that we really like are Citizens Financial and KeyCorp. Both trade at 10 times earnings. Both are about 1.5 times tangible book. What we like about both these stories is the ROE improvement story is largely time-based and it's baked in. And so you're going from a below average return on equity to peer-like or better over the next couple of years. We also think the potential for them to do an acquisition is lower. And because of that, we think the PE valuation can expand pretty considerably.
Now, we have seen growing pressure on regional banks to merge, whether it be to cut costs or maybe compete with some of those bigger players. Is that an expectation that you could see over the next year or two? How vulnerable are these mid-sized banks?
We're seeing it. We're seeing banks consolidate at a pretty healthy pace. And to put some pen to paper there, on average, 3 to 4% of the banks consolidate every year. We've gone through this period of anti-merger and anti-bank regulation, very tight regulation. What's happened over the past 9 months is we've seen a loosening in the regulation. That's not to say regulation isn't strong, and it needs to be, and it is. But we're seeing deals get approved quicker, which means there's less uncertainty as banks position themselves to come together. We think, again, to bring it back to my earlier point, scale is winning. Scale is really important in the banking business, and scale can be accomplished through M&A. So we're starting to see it. We're starting to see the regulatory bodies approve deals. There's a more pro-business legislation out there. And so we think that's only going to continue to accelerate, especially with valuations improving. The math can work.
And Comerica has come under pressure from an activist investor pushing for a potential sale. And like you were saying, I mean, regulation is really top of mind for activists. That's usually why they avoid going into banks for their campaigns. So what do you make of this Comerica news and why we're starting to see a lot more campaigns like this now?
Well, we like Comerica fundamentally. We have a buy on the stock. We've had a buy on the stock for a year. Really, the call has been very, very inexpensive valuation. This is a company that needs lower rates to make the ROE improvement, to make the margin really reach its full potential. But in terms of M&A, I mean, this is an asset that people want, right? They are in great markets. They're in Texas. They're headquartered in Texas. So they're in demographically attractive markets. The returns aren't where they need to be. And I think the view from that investor you're referring to is that that could be a potential combination. Now, I won't speculate on the potential for that to happen, but Comerica is a bank that has incredible earnings power over a multi-year basis, but really it comes down to executing on a day-to-day basis near term.
And we've been monitoring the bond market. We saw a bit of a sell-off yesterday. It seems like we're having a bit of a rally right now, a reversal of what we saw. But how do you look at the long-term yield curves, like the 10-year and the 30-year, and the impact that has on these banks?
I mean, in general, we're coming out of the longest inverted yield curve in history, right? We just turned positive on the 2s, 10s last year after a couple of years of being inverted. So steepness is better. Steepness for the right reason is also important, right? So if the long end is reflecting growth and inflation expectations, if inflation is becoming under control, that would be the best outcome for lowering short-term rates. So we are entering a period where the Fed is messaging they are going to cut short-term rates. Now, the Fed can control short-term rates more so than they can control long-term rates. That's not to say they can't do policies to impact the long end. But if the long end is, if we have some general steepness to the curve, the banks can make a lot of money, right? You can lend at a pretty attractive spread. You can fund your balance sheet pretty attractively. And so we think we're in a period where margins are expanding. We're starting to see it last year. We're going to continue to see this back book repricing narrative over the next couple of years. And that's a pretty good strategy for earnings growth.
All right, Christopher, thanks so much. Appreciate it.
Great.
Coming up, some of the morning's top trending tickers, plus why tariffs are putting food companies like Campbell's Soup under pressure. Now time for some of today's trending tickers. We're watching Boeing, American Bitcoin, and Neptune. First up, a look at the airline industry. Canada's WestJet secured its largest ever aircraft order with Boeing, buying 67 aircrafts. This order increases the airline's current fleet of 193 passenger aircrafts. It comes as the company looks to advance its growth strategy to build a stronger, resilient, low-cost airline. Next, American Bitcoin. The Bitcoin accumulation platform begins trading on the NASDAQ under the ticker symbol ABTC. The Trump-backed company delivers institutional-grade exposure to Bitcoin. The business model integrates scaled Bitcoin mining operations with disciplined accumulation strategies. American Bitcoin making its public debut following the completion of its stock-to-stock merger with Griffin Digital Mining. Finally, Neptune, the flood insurance provider filing for a U.S. initial public offering. Neptune uses advanced technology, including AI, without any human underwriters to assess risk. The company posted net income of $22 million on $71 million in revenue for the first 6 months of 2025. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, shares of Campbell's higher after the company's fourth quarter earnings per share topped analyst estimates. However, the maker of Goldfish and Milano cookies did share a softer than expected profit forecast for fiscal 2026. Campbell's expects tariffs to cost roughly 4% of cost of goods sold, as the packaged food market is already under pressure as consumers shift their spending and eating habits. Nick Modi, RBC Capital Markets Managing Director, covers this sector closely and joins us now with more. So, Nick, let's get into Campbell's results here. I mean, are you surprised to see that the stock is rising right now?
Not really. I mean, listen, we were expecting a pretty tough guide from the company, just given all the headwinds. I think the market was anticipating the stock has obviously been under pressure for the better part of the last 2 years. So, this is, I think, just somewhat of a kind of relief rally. It was bad, maybe not worse than what everyone was expecting going into the print, but let's not, slice the message here. It's a tough environment for the packaged food industry right now.
And Campbell's warning about tariffs. What does that signal to you about the hit that we could see from this company down the line and really big food in general?
Yeah, this is going to be a pretty broad-based issue. I mean, I know there's a big debate on, the tariffs aren't creating inflation. Well, we're going to see, I think, the inflation come because most companies were just kind of waiting on the sidelines to figure out, what the magnitude of the tariff would be and if there would be tariffs at all. And so I think you're seeing a lot of companies kind of absorb the impact, but now you're going to start seeing it get passed on to the consumer. And so that's why we're quite cautious on the consumer over the next 2 quarters, because we do think rising inflation is going to have an impact on consumption behavior.
And you mentioned price hikes. It could be a lever to pull to offset some of that tariff impact. What other levers do these companies have? And are there certain specific businesses that are doing this better than others?
Yeah, I mean, look, you have productivity, obviously cost savings. Some of that could also include headcount reductions. AI is obviously helping companies become more efficient and productive, especially in the back office at this point. So you have a lot of kind of what you would call kind of cost areas. You also have innovation. Can you launch a innovation at a premium price because it's so unique and differentiated, whether it be a new flavor or a partnership with another company to drive volume? That could help because you can get premium pricing on that. And then price pack architecture, right? Which is, hey, let me offer a smaller, more affordable price point, but on a price per ounce basis, it's actually higher, so you actually get some pricing that way. So there's a lot of ways. These companies have a lot of tools in their toolkit to offset tariffs, but it's not enough. They're going to have to take some pricing if they want to maintain their margins.
And given that, you do say that you're cautious on the consumer, and at this point, we really haven't seen that pass-through impact yet. A lot of these companies are absorbing that cost, like you mentioned. So if we do see these costs get passed on to the consumer, where does that leave consumer demand?
Yeah, I mean, it means consumers are going to have to make choices. The good thing about the consumer staples industry is these are products you need on an everyday basis. But that doesn't mean the consumer won't make choices, right? Will they opt to buy a private label instead of a branded product? Will they opt to eat more at home than eat out of home? And that's certainly something that helped Campbell in its broth business, right? People are literally cooking at home more because it's more economical. And so, you're going to start seeing these trade-offs. Now, we've been in this kind of mentality, kind of consumption behavior for the past year and a half, right? I only think it's going to get more extreme as we start to see prices go up. And so let's hope that as we kind of, get deeper into the year and we turn the calendar, things start to improve. But it's really hard to pinpoint what would drive that at this point.
Mm-hmm. And we also are seeing big moves across the sector. Kraft Heinz, for example, exploring splits. Elliott Investment Management pushing PepsiCo to rethink its structure. With snacking in general under pressure, how do you view the overall landscape and sort of the changes that we're seeing underneath the surface?
Yeah, I think for snacking in particular, this is one of the hottest segments of the entire category or consumer staples industry up until about a year ago. But I think the problem is many of these companies overpriced around the last cycle of inflation, right? And so when you think about snacking and you think about exposure to lower income consumers, I think at this point, a lot of these products may have been priced out of the reach of the consumer, and they're making these choices. They're deciding, they'll either skip the snack or they'll opt to buy something else that might be cheaper. And so, in the absence of prices getting rolled back, which clearly is not going to happen given that I think more pricing will go into the market because of tariffs, it's hard to really see a sustainable recovery in the near term. Again, let's hope that things start to improve as we get into 2026. But for where I sit right now, it's really tough to call a recovery at this point.
Right, and to your point, if consumers are skipping snacking or buying something else, it feels like the companies that are best positioned are ones that have a diversified portfolio. What are those companies in your view?
Yeah, you have Mondelez, you have, obviously Pepsi has also a beverage business, but that's struggling as well. Hershey is a pure play, so they're obviously under pressure, but they've been really innovating and gaining share. And so that's a good example of, hey, even though the environment is tough, if you're doing the right things and you're getting enough new product and excitement into the marketplace, you can actually drive a growth in an environment where there is no growth, right? So, but look, at the end of the day, the packaged food sector is really under a lot of pressure right now. Snacking is just one of the segments that's under pressure. There's a lot of segments across packaged food that are struggling. And so, we think inflation is a big reason why that's the case right now.
Does this create maybe some buying opportunities if, tariffs are really a short-term blip in pricing?
Yeah, I mean, what we've been advocating for, the multiples of these stocks are very low. I think they're as low as they were back when the tech bubble was forming, right? So pretty cheap. But numbers have been coming down. And so our thesis coming into the year is, look, all these companies have to bring their numbers down and create some level of safety in their earnings stream, right? That's the whole reason you buy these stocks to begin with. We're starting to see that now, right? So we're kind of going through the process. Numbers have come down pretty much across the board. I think we have a few more companies to go, but pretty much across the board. When that happens, I think then you start saying, hey, there's opportunity here, because if the market starts getting spooked because of tariffs and because of consumer spending weakness, they're going to rotate into these stocks. And if there's no earnings risk or limited earnings risk, I think you'll actually see these multiples start to improve. So that's kind of like how we're thinking about the space right now, with the full acknowledgement that the fundamental picture is still very tough.
Right, and finally here, Nestle, one company we watch closely, just ousted its CEO, and this is coming as the company faces a lot of those rising costs, that challenging consumer. How important is leadership stability at a time like this?
Incredibly important. In fact, I believe it's underrated. I mean, I don't think it gets enough focus, right? Continuity is really, really important, especially when you talk about the divisional levels, right? Like the people running these businesses, whether it be category or segment, them having continuity, them aligned with the rest of their organization, everyone's kind of running in the same direction. That can never be understated, right? I mean, the reality is when you get that right, you can outperform your competition, and that's why continuity is so critical.
All right, Nick, thanks so much. A lot to keep track of in this space. Appreciate it.
You bet.
Well, all your market action straight ahead. Stay tuned. You're watching Market Catalysts.
The future of the Fed could be decided in a courtroom. That's right. Whether or not Fed Governor Lisa Cook stays or if she goes could set the course of interest rates over the next 2 years, and that's what we're breaking down on today's Stocks in Translation. So let's get you up to speed. Trump has already moved to fire Governor Lisa Cook over allegedly mislabeling her mortgages, claiming multiple homes as her primary residence in order to get better terms on a loan. She sued in federal court, and now it's up to a judge to decide if that holds up. And if it does, the balance of power at the Fed could shift by early next year. But before we go any further, we need to break down how the Fed actually votes to raise or cut rates. And to be precise, it's not the whole Fed that's voting. It's something called the FOMC, or Federal Open Market Committee. And here's how it breaks down. There are 7 board members in Washington who vote at every meeting, plus 5 of the 12 regional Fed bank presidents, which rotate each year. And together, that makes 12 total voters, 7 governors plus 5 regional presidents. The governors who serve on the board are presidentially appointed, and the presidents of the regional banks, they are picked locally. But here's the catch. They have to be approved by the board, so if the board changes, the regional presidents, they can change too, and that's how the Fed could radically shift. So what's up next? Step 1, the courts will rule on Cook's dismissal. That could come in days or weeks. Step 2, in February of 2026, all 12 Fed presidents are up for new terms, including the 5 that will vote. And step 3, in March 2026, at the very next Fed meeting after those regional bank presidents are selected, we could have a brand new voting lineup. Now, markets, they are already pricing in or starting to price in a more dovish Fed, which could mean likely more rate cuts. And this chart, and much of this analysis, by the way, comes from Alfonso Peccatiello over at the Macro Compass. This chart shows the 5-year TIPS yield, or real yield. Think of it as the true cost of money after inflation. It goes back over a decade, and we've shaded in the area between 0 and 1%. Those are 2 key levels. And when the rate was below 0 over the pandemic, that basically meant free money. That was ultra loose Fed policy. But after the Fed aggressively hiked rates in 2022, that rate, it surged above 1%, which is considered restrictive policy. And you can see this rate is still hovering above that neutral line at 1%, so the Fed is still a tiny bit tight, but just barely. If it now drops under 1%, that signals looser policy. And if it goes way below 0 again, it means investors are losing purchasing power even with Treasury bonds. But enough of the wonky bond stuff. What does this mean for your portfolio? According to Peccatiello and the Macro Compass, the last 2 times that real yields crashed through the neutral rate while inflation expectations were rising, that was in 2011 and 2021. And that's when investors rushed into riskier bets. History shows that small caps and bank stocks can lead in this environment, while commodities like silver and gold, they can also do well. And it's probably not a coincidence that gold is surging to record highs over the last few days, and silver, meanwhile, is making fresh 14-year highs. And while crypto really was not a thing in 2011, Bitcoin and other tokens, they really took off in 2021. And finally, the dollar. The dollar should tend to weaken in this scenario, which usually helps foreign stocks. So while markets might be pricing in some of this right now, we still need to watch to see what decisively happens next. Court rulings on Cook, they're happening right now, and we could get a decision in the coming weeks. And then February 2026 is when all of those regional Fed seats come up for renewal. And March 26, a month after, is the first meeting where a new lineup could take the field. And market-wise, keep an eye on inflation-adjusted rates and also dollar moves. Another leg down in the US dollar would be a big deal. But if Cook wins her suit, watch out, because all that looser Fed policy that's getting priced in right now could be reversed quickly. So watch out, gold bugs. And tune into Stocks in Translation, the podcast, for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. Stay tuned for more market catalysts.
Private jet company Wheels Up announcing its new signature membership with premium offerings for its customers. Joining me now for an exclusive interview laying out the details of the program is George Mattson, Wheels Up CEO, and our very own Praz Supermanian is here for the conversation as well. So George, new membership, give us the details. What does it include and why roll that out now?
Yeah, thanks for having me on, Allie. Look, you really have to take a half a step back to what we announced in October of last year, which was about a year after the Delta investment into Wheels Up, making Delta our strategic partner and our largest shareholder. What we announced a year ago was that we would be revitalizing and modernizing our entire jet fleet, replacing 4 legacy jet fleet types with 2 new jet fleet types, the Phenom 300 and the Challenger 300 series aircraft. And so the announcement today, a little ahead of schedule from our intention to have it done by year end, is a program in which our members can now access those aircraft on a guaranteed availability nationwide basis through this signature membership offering.
So basically what you're saying is that, I think we were talking offset about this, is that in the past, you could either pick dynamic pricing or fixed pricing based on what your needs were. And now, because you basically, you essentially book the whole plane, now you can actually kind of say, hey, I want to pay fixed for all these different things or pay dynamic for all these things, right? That's sort of what's giving more flexibility?
Yeah, look, the whole centerpiece of what we announced today is around customer choice and flexibility. So there are customers who are flexible in how they travel, who can benefit from dynamic pricing, where we would price lower at off-peak times. There are customers who want to know what they're going to pay. And so in the spirit of offering choice across the fleet and really flexibility within our offering, we're offering 2 pricing options, a fixed rate per hour and a dynamic rate based on day and time of day.
And with the Delta partnership, can you explain how important that strategic alignment is? And what does this guarantee the rider? You go fly Delta Premium, and then you can go on a Wheels Up jet from there if you're traveling further?
Yeah, the decision Delta made, and the decision I frankly made to come off the Delta board to lead this company on the back of the Delta investment was really predicated on doing something unique to aviation. So if you think about aviation from the very beginnings, private and commercial aviation sort of existed entirely separately in two different ecosystems. And what we're really doing is trying to deliver to customers travel choices that span across private and commercial, premium commercial aviation, and hybrids of the two. If you think about how customers select travel, they're not looking for the same solution for every trip. They're looking for a custom solution, trip by trip and segment by segment. So today it might be a short trip to Nantucket or Martha's Vineyard on a small aircraft. Tomorrow it might be a long trip to California on a larger aircraft. Might be a Delta flight. It might be a last mile, first mile solution combining premium and commercial. And then within our partnership, there's also some really unique commercial opportunities. If you think about the access we're getting to corporate customers, the 45,000 corporate customers of Delta supported by their 1,000 person sales force, that's now in our frame of commercial opportunity. You think about the 20 million active Delta SkyMiles members, and even if, let's say, 0.5% of those folks can fly private, that's 100,000 customers. You know, a study was done a few years ago that suggested that the vast majority of people, 90% of people who can afford to fly private, have never flown private. Well, where are those folks? Well, they're sitting in the front of the cabin at places like Delta and trying to figure out how to access an industry that has been pretty short on innovation and really kind of come to the market with, you know, a hammer type solution and everything's a nail. And what we're really trying to do between our membership offering, like the one we announced today, our leading global charter business, and Delta, is really give customers a toolkit of aviation solutions from which to select what they want to do, not for every flight, but really flight by flight.
So George, you mentioned that big TAM, right? You talked about before about people that subset of people that can afford to fly, but they don't. So my question is, how do you convince someone that's like, you know, I'm happy with Delta One, like I get to go where I need to be. Why should I pay, like, you know, a significant amount of money extra to fly in a private jet?
Sure. Well, look, I think the value proposition, and we do try to spend a lot of time talking about how to think about that value proposition. The vast majority of people who fly private also fly commercial. So it becomes about giving people the tools to make those choices for themselves, whether they're choices around a trip need involving a business need or an individual leisure need. But look, if you fly 15 or 20 times a year, we're certainly happy to take you all 15 or 20 times, but there might be those 2 or 3 or 4 trips where it just makes more sense. It's that extra night away, it's the 3 stops you're trying to make to see plants or customers or investors. It's that extra day at your vacation home for a special occasion, and really tying it into this idea of making private aviation accessible and sensible, as opposed to something kind of aspirational and out of reach, and candidly very confusing, and just trying to knock down all the barriers that have prevented people from trying it.
Can you give us a rough estimate on how much these flights cost? Just so I can live vicariously through these folks.
Look, it really varies by trip length and by aircraft type.
Of course, right.
And also remember, when you charter the aircraft or acquire the aircraft, you have all the seats on it. So if all the seats are full, you know, it's interesting. I'll give you an example. So this summer with Delta, we have launched a pilot this summer whereby if a customer buys a Delta One itinerary to one of 5 focus cities, Athens, Nice, Naples, Barcelona, Rome, they'll get a prompt when they buy that Delta One itinerary that says, if Athens isn't your final destination and you're traveling onward and you want to travel on Wheels Up, click here. Thousands and thousands of people are starting to click and think, really rethink, rewire how they think about their travel options. It's no longer commercial or private, it's and private. And to come back to your question, if you buy 5 or 6 tickets in Delta One to Athens, the cost of that private aircraft won't be a multiple of that total cost. It actually might be a fraction of it. And so this whole last mile, first mile dynamic is also pretty interesting. Look, if you're flying to Palm Beach with your family and you're spending $1,500 or $2,000.
I love my Palm Beach.
You love Palm Beach? And you're spending $1,500 or $2,000 per seat for your family of 6, and so you're into that trip for $12,000. The answer to your question is it wouldn't be much more to have your own plane.
And we only have about 30 seconds, but it seems like you're really doubling down on the high-income consumer. They're doing well, holding up very well in this environment?
Yeah, look, we've seen real resilience through some of the economic and the geopolitical uncertainty over the last several months. I'd say the private aviation market is steady, growing a little bit. Certainly, came off of a big bubble with COVID and has sort of normalized at a higher level, baseline level than we saw in 2019. And I think that's really consistent with, this desire people have for experience and for premium. And we're benefiting from that. The macro, last thought I'll leave you with is the macro in this industry and the TAM is very exciting. If you look at how private aviation aircraft are utilized, 70% of them are still wholly owned. And this 30% that we all operate in, us and the other large providers, the dominant model is this fractional timeshare model, which really is ripe for, I think, disruption and innovation. So between fewer aircraft being wholly owned and more being operated, and I think customer-centric solutions like the one we announced this morning becoming a bigger part of it, there's lots of reasons for excitement.
All right, well, maybe one day I'm manifesting I can be a Wheels Up member.
If you're heading to Palm Beach, we'll try to make that happen.
I love it. George Praz, thank you so much. Appreciate it. Well, that's it for Market Catalyst. I'm Allie Canal. Thank you so much for watching. More Yahoo Finance straight ahead.